let's kick things off. Today, what we're going to talk about is preparing our fund for this 30th of June, but more importantly, getting things ready for following on from the 30th of June and moving into the 1st of July. So as I always ask for, if you've got any questions, please put them in the chat box, sorry, not in the chat box, in the Q&A box, and we will I will answer them as we go through. But look, today's session is really a little bit of an overview of some fairly significant changes that are occurring from the 1st of July 2022, but also tying them in with your responsibilities as trustees up to 30 June this year. So with those responsibilities for this year and the changes from next year, you just need to be aware of the ramifications of what those changes mean, because they actually, whilst they're small but significant, they can actually have some taxation ramifications. So I want to cover off on those potential ramifications for you today. What we'll also talk through is a bit of an estate planning update, and this is hot off the press. So this information that you're getting was literally released from a High Court decision this morning. So you're the first people, or amongst the first people in Australia to hear this outcome, and this outcome is very significant for self-managed super funds and the provisions of binding death benefit nominations. So that is nice and hot off the press. But yeah, largely today will be about contribution rules, with a little bit of finishing off on some of the other, reminders and pension, bit of a pension update for moving into the new financial year. So, as I said, from a housekeeping point of view, you've got the Q&A area on your screens. If you type in a question, you can remain anonymous. You can put your name in it. Either way, it doesn't. It's okay for me, and I'll answer the questions as we go through. But also, then what I like to do is, when we provide you with a recording or a copy of the recording of the presentation, we'll also provide everybody with a copy of the slides. And then also, if there's any questions asked throughout the presentation, I'll make note of those and summarise them and include them in the email that we send out to you post or following the presentation. So, estate planning update. As I said, this is hot off the press. I'll run through it in fairly simplistic terms today, but I suspect that from a personal planning point of view, is something that we as an administration company will review with all of our existing clients to make sure that all of the documentation aligns. But also it's something that will be very clear on moving forward, that from an estate planning point of view, it is really important that people seek the appropriate advice with regards to setting up, from an estate planning point of view, their binding death benefit nominations versus reversionary pensions, for example, but also how those things align with their trustee. Now, as I said, this was released this morning. Hill versus Zuda Proprietary Limited was actually a Western Australian case where the beneficiaries challenged the decision of the trustees to follow the terms of a binding death benefit nomination. Because the binding death benefit nomination was written as a non-lapsing binding death benefit nomination, and the beneficiaries argued that the self-managed super fund was required to follow the law, and the law being the SIS Act provides that binding death benefit nominations are only valid for 3 years, must be witnessed by 2 independent parties, and obviously must also nominate a superannuation dependent as such. But it was really largely around the validity and the capacity for a nomination to lapse or be non-lapsing. Now, as a guide, the tax office many years ago now came out and said that self-managed super funds could have a binding death benefit nomination in accordance with their trust deed, and that's how largely as an industry we have operated. It's been tested a few times in various states, and each state authority, so each court system within the various states that have questioned this concept, have all gone to the same, or come to the same conclusion, that the deed will dictate the terms, meaning that you can have a non-lapsing binding death benefit nomination. But of course, the highest authority in Australia is the High Court, And this case that was held in Western Australia, they appealed to the High Court to get a position on it. And the High Court effectively rejected that appeal this morning and gave their ruling that self-managed super funds can have binding death benefit nominations, subject to those binding death benefit nominations being written in accordance with the guidelines set out in their governing rules, so within their trust deed. So therefore, if we want to have a binding death benefit nomination that we want to make non-lapsing, then the trust deed must stipulate or must provide that it is non-lapsing. All the other terms, the signing requirements, all those other elements should also be considered or written into the trust deed. So this is obviously an area that has generated a lot of speculation ultimately for the last 20 years, to be fair. And a lot of people have maintained their 3-year lapsing nominations, and in itself that is a good review process anyhow, whilst others have jumped straight on the idea of doing non-lapsing nominations. Now, what I will say here to everybody is that there's no right or wrong nomination process. However, to me, the key issue is the regularly reviewing any nominations that members make, because if you do make a binding nomination, and if that nomination is non-lapsing, and then something occurs to one of the parties, or if something occurs to the party that has made the nomination and they potentially haven't updated or haven't recently reviewed it, and that money is determined to go to someone who they potentially no longer want it to go to, then obviously from an estate planning point of view, it could create other issues. So it's great to get this Hill versus Zuda scenario out of the way and definitively get a position on the use of lapsing versus non-lapsing binding death benefit nominations for self-managed superannuation funds. In large, it doesn't change people's processes and concepts around whether they should or shouldn't be reviewing their nominations. It just gives certainty that whilst 3 years is an availability tool for non-self-managed superannuation funds, it's largely going to be something that self-managed super funds use if it's written into the deed. So really wanted to get that out there. As I said, hot off the press this morning, binding death benefit nominations. We will send out a trustee update as well on this once I've had a little bit more time to read through the entire ruling from the High Court. We will put a trustee update out there for people to have a greater understanding and appreciation of what that means for their existing and future nominations in the SMSF space. So let's jump straight into the contribution update that is making up the large portion of today's webinar, so we can work through all of the key issues as I see them in this space as they apply both now and in the future. Now, I've put a post 1 July 2021 timeline because we've actually seen a lot of changes occur in both this current financial year and from next financial year. And so, you know, I think it's always good to refresh our minds and our memories about what we've been able and what we are able to do in this current year, as well as start preparing for next year in our decision-making process as well. So the key thing that we got from the 1st of July 2021 was that our transfer balance cap was indexed and our contribution caps were indexed. Now those things were not always indexed together at the same time because their calculations for indexation differ, but they did both occur at the 1st of July 2021. Now both thresholds, so the general transfer balance cap is $1.7 million for 30 June 2022 as well. The concessional contribution cap for 2022-23 will also be 27,500, meaning the non-concessional cap will also be 110,000 and the bring forward up to 330,000. So the numbers that applied for this year will also apply from next year, but those general transfer balance cap, the $1.7 million, is more likely, in my opinion, to index before the contribution caps index in the next sort of time frame of indexation. And really, you know, my mindset behind that is that as we're seeing a lot, inflation is certainly taking hold in Australia at the moment. And with those inflationary measures, it means that the consumer price index is higher, which means that the general transfer balance cap will index quicker than the average weekly ordinary times earnings rate that is linked to contributions. From 1 July 2022, we do have a work test amendment, and that's going to be the key message from today's webinar, is what it actually means from a capacity to contribute into super, and then the potential ramifications that that work test amendment have after the 1st of July this year. We do have, because of these changes, the capacity to make non-concessional contributions up to age 75. So that is a significant change, given that the current rules provide for us to be able to do that up to age 67 without meeting any other requirements. Now moving up to 75 is going to be pretty significant. The other change is, or the other significant change is our downsizer contributions will be, or eligibility for downsizer contributions down to 60 from 65. I'll run through that as well. First Home Super Saver Scheme, giving us the increased capacity to withdraw up to 50,000 rather than the current 30,000. And a lot of these things, to me, and particularly the non-concessional and the work test rules, mean that we've got to take care in the excess non-concessional contribution regime where we put too much money in. I think there's a greater likelihood for us to trigger this as a problem moving forward. So I want to address that today to make sure that as trustees, you're aware of the ramifications of doing the wrong thing in that bracket between 67 and 75, and what that actually means from a super fund point of view. So look, I wanted to highlight this contribution strategy slide, which is something that I prepare and provide whenever I'm talking about contributions. But I want to be clear that that I am highlighting that this is an area that trustees need to seek appropriate and licensed advice on if they're contemplating all strategies, because the changes to the age test for me mean that people will start to look at, and you'll start to read articles about the use of things like recontribution strategies and what it means from the capacity to make downsizer contributions and to use the bring forward non-concessional contribution cap as well as carrying forward concessional contributions. So, you know, I've highlighted there, those points that are highlighted are the strategies that are impacted by these changes that apply from the 1st of July 2022. And so anyone that is contemplating these strategies should do so with the appropriate advice, because there's a case that came out recently where the tax office, or where a trustee / member appealed to the tax office because they got an excess non-concessional contribution assessment or determination from the ATO, and they appealed and they asked that amount to be disregarded. They asked for the contribution to be disregarded or reallocated, and their argument was that one, that they had actually been quite sick and they'd been seeking treatment for their illness, but two, they had read the information on a website, and three, that their accountant had not given them information to say that they couldn't make the contribution. So they applied a number of measures when saying to the ATO, we made a mistake, but these are the reasons why we made a mistake. We want you to ignore the mistake as such. And the tax office and the Administrative Appeals Tribunal basically came back and said, none of those reasons, which are all quite sound reasons in life for making mistakes, none of those reasons are justifiable to allow us to reallocate contributions or to disregard contributions. So really what they're saying from an SMSF point of view is you make contributions knowingly, whether you know the rules or not. So it's really important to understand that in all of these various contribution strategies that you might hear about and seek guidance on, you know, doing your research and getting the appropriate advice is going to be important to ensure that you don't breach the legislation, because the ATO are basically saying ignorance is not acceptable, and you'll still be penalised for it. So that's why I do like to highlight all those strategies on there for you, to show you that there are a number of key areas that could be triggered by these changes and avail themselves to you, but you still need to make sure you understand what the actual rules are. Which brings me to what the current rules are, so that we can distinguish between now and the next fortnight and everything that we do following this fortnight with regards to contributions after the 1st of July 2022. So as it currently stands, anybody who is under the age of 67 can contribute to super, can make personal contributions to superannuation without satisfying any work test requirements. So without being gainfully employed, we can make contributions up to age 67. Right? We can also make downsizer contributions after age 65. We're not eligible to make them under the age of 65. And of course, we've also got our mandated employer contributions, which is our superannuation guarantee, but we can also make salary sacrifice contributions and personal deductible contributions right up to age 67. So that's the rules as they currently apply, including the use of the bring forward provisions. From 67 to 75, then we're entitled to receive our mandated employer contributions. So again, the super guarantee, which is currently 10%, next year goes up to 10.5%. We can make personal contributions, so we can make member contributions and employer contributions, such as salary sacrifice contributions, subject to satisfying the gainful employment test or meeting the work test exemption. And I've got both the gainful employment test and the work test exemption explained further throughout the presentation, but as it currently stands, once we hit 67, then we have to meet other requirements before we can make personal contributions to our fund. We can also make our downsizer contributions, and then after the age of 75, then we're only able to receive mandated employer contributions, and we can only make personal downsizer contributions from selling a property. So, you know, when you break this down, and this is actually a consolidated version of the rules, because the rules actually break it down even further within the SIS regulations, the superannuation regulations, they do actually provide like a lot of different sort of questions you have to ask yourself when, as trustees, you're actually accepting contributions. And this is the key thing, is that we're not really talking about it from a membership point of view. We're actually talking about it whether you as trustees can accept it. And so if somebody in this instance is over the age of 67 and they don't satisfy the gainful employment test, or they don't meet the work test exemption, then the fund cannot accept those contributions, and therefore the amount must be returned. However, if somebody is under the age of 67, they can contribute, but if they contribute more than their cap, then they're subject to the excess contribution rules and would have to pay tax on the associated earnings. So our gainful employment test, we need to be employed or self-employed for gain or reward in any business, trade, profession, vocation, calling, occupation, or employment, and we must do 40 hours in 30 consecutive days. Now, I want to highlight that those rules, that definition doesn't change moving forward, but where the rule sits within the acceptance requirements and within the membership requirements of super fund moves from the superannuation law to the tax law, and I'll explain that in a moment. But that's what our gainful employment test requires. So we must be employed or self-employed for gain or reward any business, trade, profession, vocation, calling, occupation, or employment. So it's always been one of those difficult things as trustees, because you need to be satisfied before you receive the contribution that you as members have met that test. Now, most of the time, it's easy to tell whether or not you are working or not. It's whether or not you are engaging in something that maybe is a little questionable from a working point of view. And often you'll see people say, okay, well, how do I make contributions? What do I need to do from a work test point of view to make these contributions? And they try to identify a whole heap of let's call it activities that are beyond their normal activities that potentially could meet the gainful employment. But I would always say to people in those circumstances, well, are you willing to declare that income to the tax office, and are you willing to state that you are self-employed or whatever to the ATO in the event that they question it? And that would often be the sort of the litmus test as to whether or not someone would meet the gainful employment test, is are you willing under any circumstances to declare that as being employed to the ATO and to declare that income? So that would often be one of the key triggers. So the current work test said resides within the SIS regulations, and it's requirement that you've met that work test before the contribution is accepted. So the trustee must be satisfied that you've met that requirement before you actually make the contribution. And that regulation 7044 is what I talked about momentarily, which was if you didn't meet the work test and you're over 67 and you made the contribution, then that amount couldn't be accepted and had to be returned to the contributor. So basically, if you didn't meet the requirements to accept the contribution, then the amount was not a contribution and had to be returned within 30 days of it being made to the superannuation fund. And so that's why for any of you that are over the age of 67 or potentially previously 65 and you contributed when you shouldn't have, you would often get the auditors raising a breach of the legislation, not because of the contribution, but because that amount wasn't returned within 30 days. But then they would report to the tax officer that it had been fixed once that amount had actually been returned. So what we then have to do is we have to now turn this around and say, okay, well, for this year only, we are looking at contributions, or we're looking at the work test with our capacity to accept contributions. So if anyone's looking to make contributions and they're in that age group over 67 in this current year, and they're looking to make a contribution, then before you accept it, you must be satisfied that they have met that gainful employment test if those contributions are to be made. So that's what you're looking out for within the next fortnight of this financial year. From the 1st of July 2022, our rules are simplified to a far greater extent, giving us a far greater capacity to make contributions, but with that capacity comes ramifications that I want to highlight to you today. So if a member is under 60, the fund may accept contributions made in respect of the member that are employer contributions, so any employer contributions or member contributions. So we can make our spouse contributions, we can make our non-concessional, we can make our personal deductible contributions. If we're under 60, we can make any of those contributions. Those contributions, of course, if they're member contributions, will always be subject to our total superannuation balance, which will measure against the general transfer balance cap of $1.7 million to see what our non-concessional contribution cap is. If the member is not under 60, but is under 75, then again, we can receive any form of employer contribution or member contributions, including downsizer contributions. So this is now the key, whereas the previous table had that bracket sort of 60 to 67 or 60 to 65 and then 65 to 67, and then 67 to 75, where they had an extension of that point B there, which said subject to meeting the work test. That has been removed. So now anybody that is under 75 can make member contributions regardless of their work status. So therefore contributions are now, or not now, but from next year, are totally subject to how much money you had at the previous 30 June. So how much you had will dictate what your caps are. But what is not dictated is whether or not the trustees can accept it. And so this is where you need to be clear on what the requirements are to make sure that you don't breach your actual cap, because the trustees don't need to make an assessment as to whether the contribution can be made or not. Now, of course, this is all talking about yourself in two capacities, as both a trustee and a member. But as a trustee, you're not looking to the member for their work status to determine whether or not you can accept the contribution. As the member, you are reviewing your own total superannuation balance to determine what amount you can actually contribute to determine whether it will be excessive or not. If someone's not under 75, then we can only receive mandated employer contributions, so no more salary sacrifice there, or downsizer contributions. So what this does is it removes the work test from age 67 to 74, 75. It gives us a capacity to make contributions up to 28 days following the month that the member turns 75. So that was kind of hidden away within the regulations previously. Now it's quite clear there that what we actually have is a capacity to say, okay, if you turn 75 on the 10th of July next year, and subject to your total superannuation balance, you want to make a contribution, you must make that contribution by the 28th day of August. So 28th of August is 28 days following the month in which the member turns 75. So that's one of the rules that you need to be mindful of, is in the year you turn 75, the contributions don't have to be put in prior to your 75th birthday, but you've got that gap until, or that leeway until 28 days following the end of the month in which you turn 75. What this also does is it extends the bring forward rule. So previously, or prior to 2021, if you were under 65 years of age, you could bring forward up to 3 years worth of non-concessional contributions. Then last year, you were able to bring forward up to 3 years worth of non-concessional contributions if you are under 67 on the 1st of July. Now, if you are under 75 on the 1st of July, then you can, subject again to your total superannuation balance, bring forward up to 3 years worth of contribution. So you can make a maximum of $330,000 contribution if your total super balance is less than $1.48 million. And I'll run through those numbers in a moment. And again, it's important that you seek the appropriate advice to determine if that's the right thing for your fund to do and whether or not you are eligible to make those bring forward contributions. But the warning with these regulations is that all contributions pre-age 75 are subject to the excess contribution rules. Now that's pretty critical, because what that means is, going back to that court case, or that recent case with the appeals tribunal and the tax office, is if you put in an amount and you didn't want to put it in, or maybe I shouldn't say you didn't want to put it in, if you put in an amount and it's more than what you're entitled to put in, then you are going to be subject to the excess contribution rules. Under the existing rule, if you were 68, for example, and you weren't working, then the fund would have to refund that to you. Now, if you're 68 and you're not working, then the fund, under these new rules, can accept the contribution, but the amount you can contribute is subject to your total super balance. So if you've got more than $1.7 million and you contribute $110,000, then that will be an excess contribution, and you cannot return it to yourself within 30 days. You have to wait until the tax office issues you an excess non-concessional contribution determination, and then you have the choice of having that amount refunded plus associated earnings, and you pay tax on the associated earnings, or you leave the money in there and get taxed at 49%. Now, presumably most people will not go down the path of having those contributions taxed at 49%. They will go down the path of refunding those amounts via the tax office, not directly to the member, and paying tax on any associated earnings. So what this does, or what these rule changes do, in my opinion, is they make us more susceptible to inadvertently creating excess non-concessional contributions. So instead of looking back at the previous 30 June to determine what our cap is, we're just looking at the acceptance rules and saying, I am 69, I am 71, therefore my fund can accept the contributions. Well, that's only part of it. We then need to know what our cap is based on what our total superannuation balance was at the previous 30 June. So we do have to still review some information. So that's a key issue that I wanted to address and get across from today's webinar, is that excess contributions, I think, are more likely to arise in this new regime, because we've now got the freedom as trustees to accept amounts of money without reference to any work test and without reference to any balances, and the onus being put on ourselves as members to know what our balance was to determine our eligibility for how much we can actually contribute. So that's a bit of a difference in the way that we need to look at things moving forward. Our new work test requirements, however, as I said, the work test rules don't disappear, they just get moved. We get moved to the Income Tax Act. And so what these rules effectively do from the 1st of July 2022 is they say, okay, well, you can make a contribution up to age 75, right? And there's no work test requirement. However, if you want to claim a personal tax deduction on those contributions, so they're the contributions that we call concessional contributions, if you want to make a personal or claim a personal tax deduction, then if that contribution is made during the period, and I've highlighted it here, the day of your 67th birthday until 28 days following the month of your 75th birthday, so from your 67th through to your 75th plus 28 days following the next month, if you wish to contribute and claim a deduction in that time frame, then you must meet the gainful employment requirement during the year. So again, it's not subject to whether or not you met the work test before the gainful employment test before you made the contribution. It's in that year when you are preparing your tax return, and therefore you're determining whether or not you're entitled to claim a tax deduction. Did you meet the work test? So if the contribution was made the day before your 67th birthday, you can claim the tax deduction. If the contribution was made the day of your 67th birthday, then you need to meet the work test during that year. Otherwise, you won't be eligible to claim the tax deduction, and all contributions will be treated as a non-concessional contribution. Now, again, why do I highlight that as a key point? Well, because for a lot of people, what they will do is they will put in their 110,000 non-concessional contribution, and they will put in their 27,500 concessional contribution, thinking that they've then made 137,500 from a contribution point of view, and they'll claim a tax deduction on that 27,500 amount. Well, in this instance, if you are over 67 and you put that amount in and you haven't met the work test, then you won't be eligible to claim, and you will have triggered your bring forward because you've contributed more than 110,000. And so that might actually have consequences if you've previously used your bring forward, or if you've made a 330,000 or whatever it might be. So you actually might upset a lot of your contribution planning that you've done with your advisor or whoever else to determine whether or not you're entitled to make that additional contribution. So it's really just a key issue to be mindful of. And so you've got to satisfy the gainful employment test or the work test exemption. As I said before, that I'd come back and talk about that work test exemption. If you had less than $300,000 total super balance at the previous 30 June, and in that prior financial year you met the work test, then if you're in this year you're turned 67 or you're 68 or 69 or whatever it is, as long as you met those conditions in the previous year, you can still make the concessional contribution, you can still claim the personal deduction, but you had to have less than that $300,000 at the previous 30 June. So again, it's having a good appreciation for what your balance is, and that's your balance across all superannuation entities at the previous 30 June. Where do you get that information? You get that information from your MyGov account, because the tax office track your total super balance based on previous reporting from your self-managed super fund, any government funds, any retail industry funds that you'll have. They'll be tracking that information on there. So look, it's a fairly subtle change in the work test and where it sits, but the eligibility side of things really means that the emphasis now is on looking backwards at your balance to determine that any amount that you're contributing is not going to put you into excess. And then when you come to lodging your personal tax return, do you meet the requirements to claim that personal tax deduction? So, and because, you know, it's one of those areas that a lot of times you get asked the question, should we salary sacrifice or should we make personal deductible contributions? Well, this new work test requirement only applies to personal deductible. So you can still put in place an arrangement after age 67 with your employer to do a salary sacrifice, because clearly you're meeting the gainful employment requirement. So you can still do either or, but a salary sacrifice is not subject to this sort of test because you're already just clearly meeting the requirements. So there's no additional declaration required. So that brings me to the bring forward threshold that I wanted to touch on and highlight, just as not as an aside to all of this, but as I guess an extension of these rules. And that is because our contribution age limit has increased up to 75, and because the change for the bring forward only sort of said up to 75, so it really means that we're now eligible to contribute potentially 3 years worth of contributions in our 75th year, which was basically not what we thought the legislation would be when it was released. It basically gives us a capacity in the year that if on the 1st of July we are 74 years of age. In that year, if our balance at the previous 30 June was less than $1.48 million, we could conceivably contribute $330,000 under the bring forward requirements. So what this actually does, and it's why I highlighted that advice piece before and really sort of drill down on going and saying to trustees and to members to seek the appropriate advice, it really means that our contribution timeframes extends now, whereas before we pretty much had to do all of our contributions sort of before 65, and then we had this little window that opened up where the contributions and recontribution strategies and all those other things that people undertook had to be done between the age of 65 and 67. Now, by extension, we're going to see a lot more self-managed super funds and superannuation members in general having combination of pensions and accumulation accounts between the age of 65 and 75, with still that capacity to make contributions. So it's really important that we understand that things like the bring forward thresholds and the various acceptance rules are taken into consideration, because the bring forward thresholds need to incorporate your pension balances as well as your accumulation balances. So your total super balance incorporates all of those figures. So you need to know, if I'm going to try and put more money in, I need to go back and effectively look at the combination of what I've got in my pension account with my self-managed super fund. You might have accumulation sitting in a retail fund for whatever reasons, for insurance reasons or something else. Then you need to take all that into consideration to know whether you qualify. But once you qualify, know that you've got the capacity to use the bring forward right up until the year that you turn 75. So that is a huge difference for our industry, and something that people need to be mindful of. So I think it's one of those areas that what these rules have done for us is they've given us as individuals, as members, greater capacity to contribute, but with it, they've also given us, I feel, greater capacity to make genuine errors that are undoable. So, you know, in the current environment, we've got the capacity to make an error after the age of 67 and rectify it relatively easy with very little pain. Moving forward, we've got the capacity to make the same mistake with a very different outcome, and that different outcome is that we're going to be subject to the excess non-concessional contribution regime, and we don't just have the ability to refund the money to ourselves and forget about it. We must go through the ATO system, which means that the monies must be refunded via the ATO. The ATO will then, you know, because of the way that the excess contribution system works, the ATO then effectively have access to that money to offset against any other potential Commonwealth or tax liabilities that you might have before refunding it to yourselves as individuals. So you really do need to, and I'm not really trying to scare people as such, but rather just address that, you know, there are warning bells associated with greater flexibility. So with greater flexibility comes greater chance to do the wrong thing. So I'm just sort of trying to say, don't do the wrong thing. Save yourself the anguish of dealing with the ATO and having to get that excess determination notice sent through from us to say, hey, look, here's a process. This is what you're going to have to deal with now. Of course, by extension of these rule changes, an extension of the acceptance rules and the lowering of some ages of the others, we've got to change to our downsizing contributions. So from the 1st of July, it's now available to individuals aged 60 and over. Now, what I haven't put in this slide, because it's still sort of up for future announcements, I suspect, is that for those that were paying attention to, and we will obviously have to pay attention to the federal election with regards to, you know, requirements to vote and all that sort of stuff, but there was a lot of talk in the last 2 weeks before the election about accessing super and housing affordability and a lot of issues associated with how you can access super to buy a first home. Now, of course, that was a coalition policy, and so it disappeared with the loss of the election to the Labor Party. But one thing that the coalition said in their election promise was that they were going to decrease the downsizer contribution eligibility to age 55. Now, the Labor Party said we would support, and we would also decrease the downsizer eligibility to age 55. So what we have now is an undertaking from the new government that they are going to do a federal budget later this year. So it'll be interesting to know in that federal budget if there will be any further announcements about downsizer contributions. But as it currently stands, the downsizer from 1st of July 2022, people will be eligible from age 60. So that takes away that inequity where you had someone who was just over 65 and they had a spouse who was 63 and they sold their house, and one would be eligible to contribute on the downsizer and the other wouldn't. You've got the downsizer is basically the sale of your primary place of residence. So you've got to qualify under the tax rules effectively of it being your primary place of residence. You don't necessarily have to downsize. So you do have to meet that main residence requirement. You must have owned the property for 10 years. So this is always a question that gets asked, is if you've got a couple, do both people have to own the property, or does only one member of the couple have to be on the title? It only requires one of you to be on the title for you to be eligible to make the downsizer contribution on behalf of both members of the fund. The maximum contribution from the proceeds is $300,000 each, and it is a use it or lose it style approach. So what you've got to understand there, though, is that it's the lesser of the proceeds and $300,000. So if you sell the house and you make $500,000, then you can't add another $100,000 that you've got sitting in capital outside of super and make a $600,000 contribution between two of you. You could make $300,000 for one person and $200,000 for another, or you could do $250,000 each. You could do any combination that added up to the $500,000 proceeds, but you could not contribute more than the $500,000. So what this really does is it opens it up, particularly when you look at the next point, is that the contribution must be made within 90 days of the sale of the property, right? And so that 90 days is basically 90 days from settlement. So if somebody has settled in this current financial year, as in if they settle in June and they are 61, 62, 60, doesn't matter, whatever, but if they're 60 or over now and settlement occurs after the 1st of July, then they would be eligible to contribute, or more to the point, sorry, if that 90 days occurs following the 1st of July. So if settlements now, you've got 90 days from now, which would take you through to what's that, some stage in August, September, that you'd be eligible to make that contribution. So again, the timing of this is fairly important for those that want to look at utilising the downsizer contribution. But by extension of this, with also all the other rules around contributions extending out to 75, it means that there is probably a lot greater scope for people to really drill down and plan with their advisor or with someone who's licensed to provide the appropriate advice as to whether or not it's appropriate to use downsizer contributions at age 60, or whether that's something you might look at as a post-retirement and post-contribution strategy in 15 years' time. Once somebody has turned 75 and over, do you have the future capacity to potentially sell your next property and downsize again? So, you know, it's a once only offer. So are you better off using it earlier, or are you better off using it later? That becomes the strategic question that most trustees will know and need to go and seek the appropriate advice for. But again, downsizer, at no point in time are they subject to the work test, or are they subject to any total superannuation balance restrictions. So even if you've got more than the general transfer balance cap, you can use the downsizer contribution. However, what is important is that currently, because its eligibility is 65 and over, if you make a downsizer contribution, that money is unrestricted, non-preserved, which means you can also access it straight away. If you make that before you retire, so if you do it before you turn 65, that contribution must be preserved. So you don't necessarily have access to that money immediately. Obviously, you can go out and seek the appropriate advice with regards to transition to retirement income streams and other things, but that money would sit there in a preserved status, which would make it unaccessible as a lump sum until you meet a condition of release. So again, access to capital is always going to be an issue as to whether or not downsizer is an appropriate strategy for you. One of the other things that, look, is really minor in the SMSF space, but I wanted to address it because I think the number in the end was only about 35 to 40 odd thousand SMSF members actually used the COVID relief measures to access money from their superannuation fund. But what has occurred is since the 1st of July 2021, the government have introduced, and the ATO have now introduced, a form whereby if you accessed money up to the $20,000, if you access money under compassionate grounds for COVID, then you can recontribute that up until 30 June 2030, right? You can recontribute it and not have that amount count towards your non-concessional cap. So it wouldn't count towards your $110,000 or your bring forward amount. So you know, look, as I said, it's not going to apply to too many people. We definitely had some clients that did utilize the COVID relief measures to access the superannuation benefits. So it's just having that understanding that if you wish to put money in, you can actually allocate that money as a COVID recontribution, as a non-concessional amount, but it won't count towards the non-concessional cap. So just you know, a requirement there for people, and quite a lengthy period that there is eligibility to use that recontribution amount for. So one to keep in the sort of the back of the mind as such. The other sort of key measure that came out from I guess the last year's budget it was, and then the big raft of legislative changes that occurred in probably February this year, was the First Home Super Saver scheme. So again, this is not the pre-election announcements. This is the pre-existing First Home Super Saver scheme, where people have the capacity to contribute up to $15,000 per year. And that can be made up of salary sacrifice, personal deductible, or after tax. And then you would have the capacity right now to withdraw up to $30,000. So clearly you would need to take 2 years, and then you'd be able to access up to $30,000. Well, from the 1st of July 2022, that $30,000 increases to $50,000. So what that ultimately means is that anybody who's looking to use superannuation as effectively a holding account for saving for a deposit for buying a home, you know, if you look at $50,000 and if you look at the annual amount that you can claim out, if you're talking about maximizing the 50, but also putting in that $15,000 from a savings point of view, you're talking about a 3 to 4 year plan, or at least a 4-year plan, to put that money into savings inside super before you can pull it out. Because you can only do 15,000 a year, then 3 years only gets you to 45. So you need that 4th year, and then you'd be withdrawing the amount in the following year. So it does provide in its sort of potential the capacity for people to lock money away. But of course, if they then don't utilize it from a home point of view, then that money is preserved in the superannuation system until they retire. So it has its positives as I guess a way of safeguarding not spending the money because it's sitting on the outside, but its negative is that it's preserved, and if you don't use it for the First Home Super Saver scheme, then you don't have access to it until you retire. So that was one of the probably less significant measures that came into effect. And I actually think one of the more significant figures and announcements, and I say this because, you know, my history in superannuation dates all the way back to the introduction of the super guarantee back in 92, 93. And one of the things that has always existed there is this, if an employer pays less than $450 per month, then they're not required to pay superannuation guarantee on behalf of that employee. Well, from the 1st of July 2022, not only does the super guarantee rate go up to 10.5%, but that $450 threshold disappears. So relatively insignificant for self-managed superannuation funds, but overall in the scheme of contribution announcements, I actually think that's a fairly significant one. But if you, by extension, talk about things that have also come in over the last 2 years, we can refer back to the 6-member superannuation fund. And so where we will see potentially in the future more funds existing with younger members coming in to sit in the fund alongside their parents, then these super guarantee rules and all that will certainly be far more relevant and applicable in the SMSF space for the fact that people will staple their SMSF fund to themselves. That sounds quite awkward, but this whole concept of stapled funds that you take to your employer and your employer contributes to that fund rather than to any default fund, that's where I see sort of the 6-member fund and all the super guarantee rules becoming quite relevant. So that's sort of in by extension all of the contribution stuff that's really important. But for me, the key measure of all of that is for those aged between 67 and 75, the whole excess contribution side of things, noting that you are measuring it against the total superannuation balance, and that you won't have the capacity to refund amounts if you make errors as such, that you'll need to go through the excess contribution regime. So as I said, it's not significant to the effect that I think that thousands upon thousands of funds will do the wrong thing, but I think it's one of those things that it's a bit of a trigger to say, okay, I know I can put this money in, right? But when I'm putting it in, let me make an assessment against how much I've already got to determine whether or not I actually am over or above any caps that might apply. And that cap's going to be 110, 220, 330 or 0. And so if I'm above that 0, then that's going to be an issue. And when you link that with the personal deduction and the deductible contribution side of things, you know, if you wish to make a personal deduction and make a non-concessional, ensure that if you're over 67, you've met that work test to know that you're going to not trigger an excess non-concessional amount as well. So a very quick pension update. So our pensioner age versus our minimum requirements for the 22-23 financial year. We know by extension, and look, this is a really, this really intrigues me that this minimum pension reduction has remained, because look, maybe the government had some foresight into the current status of the market, and they obviously knew that there were issues around inflation. Now, obviously, inflation was always going to lead to a natural increase in interest rates. That we've now got this sort of situation where, as we've seen over the past few weeks, and particularly been a lot more talk about it over the last few days, is that we're getting that significant impact on the financial sector and the stock exchange, and so therefore we're seeing the values of funds and that drop down again. And so on reflection, this change is a welcome extension of an existing extension, but it kind of made me wonder, in year 2 of the whole COVID scenario, when fund balances were increasing, why were we still reducing the minimum annual pension obligation? Needless to say, we are, or the government are, and have extended the minimum reduction to 50%, and they've extended it into the 22-23 year. We will obviously keep abreast of how many more years, if any, that continues to go on, because I think every year I say that the minimums will go back or revert to their normal factors from the 1st of July, and that hasn't happened yet. So for next year, there are the factors. That is the minimum pension requirement you are needing to draw based on your age at the 1st of July. Because the big part of all of that is make sure you draw your minimum pension prior to the 30th of June this year. And again, the 50% reduction does apply for this year as well, because if you don't pay the minimum by the 30th of June, then the only solution, and it's not actually a solution, the only outcome is, unless it's so marginal, so unless it's less than 1/12 of what your minimum obligation is, right, and unless it's the first time that you haven't paid the minimum by less than 1/12, so if you fail to pay the minimum by effectively 1 month's worth of pensions, then the tax office will give you relief to say that as long as you catch that payment up and then next year you meet your minimum, then you'll get your exempt current pension income deduction. But if you've done that before, if you failed the minimum before and fail it again, then there's effectively no resolution other than the fund goes back into accumulation phase right back to the 1st of July 2021. So the entire year, all of your taxable events, or all of your previously non-taxable events, become taxable. And from a transfer balance cap point of view, the fund is reported as a debit. So the total balance of the pension is reported as a debit as at the 30th of June. And then the new pension would be started again from the 1st of July 2022. So failing to pay the minimum has consequences where, particularly if you started that pension in a high market and then you start it in a declining market, it's going to create some anomalies within your transfer balance account as well. So, you know, unless there is some form of genuine reason why you're not paying the pension because you're actually choosing to stop it, then it's really imperative that you make sure you meet that, because it can have flow-on admin effects for not only the tax of the fund, but potentially any of your estate planning and that you've done in the pension phase of super. So just something to be really mindful of there. And look, the final item that I wanted to raise with you, and I raised this in our trustee update at the end of last year, was this director's ID concept. Now, again, it came in from the 1st of November 2021, and you need to do it via MyGov, your MyGov ID. And it's basically a way of verifying people's identities and giving greater transparency across the number of companies and that might hold. But there's two real key requirements for me that people need to be mindful of. So anyone that was a new director of a company between the 1st of November 21 and the 4th of April 2022, well, that 28-day appointment, we're past that now, so they would have had to undertake that process. All of our existing SMSF trustees, if you've got a corporate trustee and you haven't yet applied for your director ID, then you've got to do that by the 30th of November this year. And if you are appointing new members to your fund under the 6-member fund rules, or you've got people when you're talking about setting up a fund or changing to a corporate trustee from individuals, then you need to apply before your appointment as a director. So you would need to apply for your director ID first, then set up your company and apply or appoint that company as trustee of your self-managed superannuation fund. So you do need to get the timing issues correct there. So look, that brings us to the end of today's webinar. As I said, we'll send you out a copy of the slides. I will most definitely be doing an update, a trustee update on this issue from this Hill versus Zuda estate planning side of things. So you will get something from us in fairly short term about that and what that actually means. And I suspect we'll also be doing a review of a lot of people's deeds and existing nominations to identify if there are any issues. So look, if anybody's got any questions, please shoot them through the Q&A box now. Otherwise, have yourself a great afternoon, and I look forward to speaking to you later in the year, probably now after a potential federal budget to be released by the new government. Okay, thanks very much for attending, and I look forward to seeing you next time. See you later.